The market just got dangerous. Very, very dangerous. Even more so than the 20-point gap down on the Monday session of last week. And the reason being is that we now have the competition of the timeframes. There are overconfident longs off of the lows who are expecting brand new all-time highs as soon as tomorrow, but we still have stubborn shorts who are unwilling to recognize the change in tone after PPI's breakout and today's CPI hold over some pretty key levels. And the truth probably falls somewhere in between these two viewpoints, and what we should do is keep an open mind to a wide variety of outcomes, but more importantly look through all of the data points to see what's actually being supported by the underpinnings of this market. So we'll do that now, but as always, check out the links listed down below, hit the thumbs up button and subscribe, and let's kick things off on the daily time frame chart. What do we see? We've got, on the trend count, a downtrend is still in force, and there's an opportunity still for a daily lower high. Now, I get it, we labeled this weekly lower high because the ideal daily lower high, you can think in terms of ideals, the ideal daily lower high would have been underneath the bottom end of this balance range. If you recall from the Saturday update video, we were basically saying, hey, counter trend move's not unreasonable, but when we get here, I will be looking for a reversal back to the downside, then your short is underneath the neckline of the hourly doubled bottom, and we'll be targeting back down here to 518. We also said in the weekend update video that to play devil's advocate, if we went through that, produced a higher low above, and then saw continuation, how could you argue anything other than a daily trend reversal after an inverted head and shoulders had been produced? So as we're making note, to the upside, there's still resistance here. You've got the upper bound of the weekly expected move, you got your daily 50 SMA, and you have the top end of this previous balance. Even if you look left, it was an interaction point from back here. 547 is a no-joke level. That's a pretty solid area for sellers to at least attempt to step up. And is it possible that a lower high is set? The answer is yes. But on the flip side of this same coin, if the market pulls back and can hold up over 537, then this is an opportunity for a possible higher low. I would even go as far as saying something like, hey, if the chart pulls back into 532.50 and we can hold the neckline of the hourly double bottom, that's also a pretty decent opportunity for a higher low, and we'll have to change our tone here on the daily time frame chart. For the bears to really win this battle, two things need to take place. You could look for short duration scalps that, maybe get us into this level, but the best place where the sellers say, no, we're taking control back, don't you think for a second that this market was bullish, is if we fail underneath 532.50. Sellers need to accomplish price action in this area to then ultimately target the equal low at 512. So this is where the sellers build back their edge. I would argue that the bulls are fighting back, and again, this is that competition of the timeframes, with these outcomes technically being acceptable to change the trend here on the daily time frame back to up. I want to be very clear about something as well. Earlier in the year, it was actually probably late 2023, but in this segment of the chart, as we were still in a downtrend for the monthly higher low pullback, we were talking about October really of 2023 when there was some panic going on, we were very reluctant to change tone back in the upward direction. And that possibly gives us a learning as we go forward. Am I going to stay overly bearish here if the market's continuing to suggest that consolidation and drifting higher is taking place, even if there's no ideal higher low that's put in on the chart? No, I'm not going to maintain that bearish stance. If we roll over and we're underneath the key level, the bearish stance resumes. But if we're over here, even without the ideal picture perfect, hey, this is the higher low, because if you look back here, right, there was no real higher low opportunity. It was more so consolidation, then a grind higher. There was no pullback to say hey, things are fine and dandy. It was really sort of this gappy, very, very thin structure market to the upside that changed the tone back for a break higher. So we're not going to make the same mistake of remaining overly pessimistic and unwilling to see the path forward for an uptrend if we're spending some time up here. So that's the daily chart in a nutshell. There are some alternate takes that I want you to be aware of. It's the daily resistance trendline from the all-time high. Confluence perfectly with that daily 50 SMA. So it wouldn't be a shocker if the market pulled back a little bit into the end of this week. But the question just becomes, is it an end of the world bearish pullback? Or if we're holding on to this level right here, is it possible that there's a hold for a higher low and a subsequent test of that trend line then breaks the market in the upward direction for a full reversal of trend? That is like the $1,000,000 question, obviously, as we come into the end of this week. And I think that we have some decent indications to be watching for that can help us, make a determination there. So first things first, let's remove this daily lower high, since now the key level is going to be the Tuesday open, and that's basically the 537 acting as the bottom end of this balance as well. There was no gap fill reversal indication, which sort of brings me to my first point. What type of participant is getting involved in the market now? Do we have new money sellers really hammering things, or do we have shorts possibly squeezing out and new money longs entering? Well, I would argue that on the Tuesday session, after the PPI catalyst, definitely shorts were either squeezing or new money longs were slowly getting involved in the market. The reason I say slowly is because for a majority of that morning session, it was a slow grind in the upward direction, right? If the sellers, let's play devil's advocate back in the opposite direction to the downside, if the sellers were really here, if PPI was going to be a nothing burger and the bearish momentum was going to continue, we should have opened somewhere, let's just even say we opened on the gap up on Tuesday, right? We should have faded back into Monday's range, set up a flat low breakdown point in here, and then looked for the rotation back into that underneath 532.50 if the bears were going to make a stand. Obviously, that did not take place. So that bearish trade, remember we were looking for gap fill reversal, come back down, break down here, lower high, was going to unlock the move into 518.75. That's out the window for now. If this is going to act as a double bottom on the hourly chart, now there's an opportunity for a higher low either inside of the previous balance range here, or as we acknowledged on the daily, something a little bit deeper could look like this, respecting the neckline of that double bottom. So if either of these two outcomes take place, I think the trend is neutral, right? Because remember, this has not gone anywhere. This is still an opportunity for a daily lower high, but the trend becomes neutral on the daily time frame because we're scouting a stronger opportunity for some kind of higher low. So how do we trade this into the end of the week? Well, the things I'll be watching for will be a look above and fail on the top end of the weekly lower high zone, aka the top end of the balance range from back here. And this is not an Armageddon short, but it's just, hey, we're at the highest high in a trend cycle. You typically don't want to be chasing new money longs at this stage, right? So a look above and fail at least sets up the opportunity to short the market from point A to maybe point B and capture some sort of pullback. Now, when we get to point B, my thinking cap immediately will be thrown on my head, and I'll be saying, all right, what are the odds that we get a double bottom down here? Can we find some semblance of buyers stepping up on the retest of this 537, the bottom of the prior range, the high of the Friday range from what is now 2 weeks ago, right? That is going to be of interest. If there is no signs of support here, then great. We're going to rinse and repeat those outcomes. So let's just say that the market looks something like this. I will rinse and repeat these outcomes over here. And if you're not confident in participating in this neckline, it's really a zone most appropriately, but if you're not confident in that, then your next recapture would be the long here. And you would try to trade, instead of from point A up to point B, the equal high, you would try to trade from point C up to point B. I know the letters are a bit inverse, but you get the point, right? This would be a slightly higher confirmation long if you're trying to truly make sure that this is going to offer some kind of daily higher low. So this is the issue with the time frames, right? Is that technically we can get a pullback as soon as tomorrow. The overconfident shorts might be saying like, hey, I told you this market's screwed, it's going to hell in a handbasket. Whereas the more sort of higher time frame removed from the emotion of the day-to-day, traders will just say, no, if I'm thinking about the trend sequence, sure, you can get a pullback here, but it's not an end of the world short. I mean, sure, if this does end up ballooning into like a trade that looks like this, kudos. In hindsight, you can tell me the shorts can come back to the channel and say, nope, you should have stuck with your original thesis. You were saying you were so bearish on Saturday. What happened, man? You're so weak hands, paper hands. Cool. Come back in a week, 2, tell me I'm wrong. But for now, reasonably assessing the risk of a trend reversal, I think, is the most appropriate course of action around these two key inflection points. So just to really reinforce the levels one more time, 547, weekly lower high zone. I imagine we start struggling up here. 50 SMA, daily resistance trend line, previous structure, top end of the weekly expected move. And then to the downside, it's the neckline zone, which is most appropriately between 532.50 and 529.50. If we check in on some Fibonacci's, let's just see what's going on from the low up to the high. I mean, look at that. I mean, right off of the bottom of the panic from Monday, if this is going to offer bull flag, it's got to stay up and over that 532.50. Kind of checks out from the analysis we had just conducted. The other thing to point out is if we come in from here down to the lows, all of this breakout session has now recaptured the 61.8. And what's the rule of thumb? The more time and bars that you close over a 61.8, generally speaking, the higher odds, like the odds dramatically increase, that you will see a 100% retracement. And that, of course, would get you your daily equal high, which then neutralizes the trend. right? So this overly attached trading mindset to the market's got to be down, it's got to make a brand new low, or hey, it's got to go straight up and make a brand new all-time high, I think is what's going to hurt most folks at this juncture of a possible trend change. So let's throw on a couple more, and then we'll get into some of the more nuanced takes here. If you bring out the anchored view apps from basically everything that matters, you're above the entire cluster. The anchored view app off of the Monday low from the Bank of Japan crisis day is slowly, not immediately, but slowly going to offer confluence around that daily higher low zone, 532.50, the neckline of the hourly double bottom from back here. Correct? So that's what I'm seeing. And keep in mind, I can't remember if we just talked about this on the daily or not, but if this pulls back and holds, now all of a sudden, how is this nothing more than just a daily inverted head and shoulders? Apologies if I already said that, but daily pattern would start to suggest that if this holds as a higher low. Correct? Your neckline breakout would then become much more interesting in the upward direction. If the market does not pull back here, I would find it very difficult to want to chase chase longs. My apologies, let's be clear. Chase longs on an extended move after this basically nonstop drift in the upward direction from the bottom of the most panicked move, right? Just your risk reward profile chasing this as a buyer as we're coming into known areas of resistance seems to be not the best risk reward profile. Whereas back here, at least, you had already offered some sort of neckline to break out over on the gap up. At least on the hold of this level, you had something to go for. If we get some sort of move over 547, I still think that the risks for a failure to come back down underneath and even just offer a pullback outweigh the possibility for continuation. So let's go ahead and take a look at some more supporting evidence here and see why that might be the case. So on Monday's session, when the market was more neutral to slightly outflows, neutral advanced decline line to bearish here. You can see that the index score was very flat. The cumulative build was bearish. On Tuesday's session, we did see strong volume inflows up and over the substantial read. We got back to positive on the net flows for the week. The advanced decline line was near trend higher zone, but look at the index score. Really, really strong read. That, of course, is an indication that all of the heavyweight components of the S&P, which really drive the intraday activity, were adding up for a continuation move higher. Really strong display of strength out of that index score on the tick, certainly higher as well. As we look at today's session, which was a mild drift in the upward direction, right? There was this opening sort of sweep, if you will, then a drift higher into the afternoon. The internals were really not as strong as what we saw on Tuesday. You can see that the index score was actually negative for a majority of the day. The cumulative build is basically flat. It's nowhere even close to substantial reads, and the volume flows are neutral as well. So am I overly confident that, again, back to the daily time frame chart for context, do you want to be a new money long here if the momentum is clearly showing signs of slowing down after this PPI catalyst breakout? I would tend to think not. I would tend to think that this location, again, is open-minded for a pullback in the downward direction, right? If we had stronger longs, you could think of it like this. As we broke out over these highs, you should have just seen continuation into the weekly lower high. The upper edge of the weekly expected move shouldn't have really offered much resistance there. It's priced in by the options market, but structurally, it's irrelevant. If you look at what happened over here, it's a thin structure breakdown, right? So the fact that we did reject the 50 SMA, to me, would indicate that buyers are starting to become a little bit more reserved in their momentum pursuit, if you will, in the upward direction. Let's take a look at the market profile out of the ES as well. And what you'll notice is that the value area is much more centered in the profile. The point of control is closer to the midpoint. I'm underscoring the yellow dot, obviously yellow line. That's the point of control. So it's not like you saw value slammed into the top end of the range, more similarly to what you had on the Tuesday session, which was really more confirmation that, new money buyers were getting active there. Value and point of control moved higher. You can see this sort of slow grind. It's a very odd looking profile with 3 TPOs across almost everything. You've got decent excess at the lows here, decent excess at the highs. Same thing on the Tuesday session, but not at the lows. Notice the lack of material excess. This is a poor low. Where we mostly went for a gap fill reversal. There's a minor bit of gap that remains unclosed, but if we need to pull back and repair that, again, this totally makes sense for the pullback outcome we were just describing. Markets pull back, we come into the poor low, we repair it at roughly 5,400, we close the gap all the way, we retest the top end of the double bottom neckline, and then we rally out of it for a possible daily higher low. Right? I think that's a reasonable sort of path to look for. Again, flipping back to the platform, especially acknowledging, I wouldn't really say that stronger sellers have made much of a stand outside of what happened last week. I mean, on Monday's consolidation, I mean, you had a bearish advanced decline line, you had bearish volume flows, but they're not even close to trend lower zone. The actual index score was not hammered down below underneath the substantial area, which is like negative 20. And the cumulative build, I mean, it got close to negative 5,000, but negative 3,300 is not the end of the world. Even if you round it to 3,500, that's not a read that the market is unable to recover from, and it's really not indicative of momentum-style sellers just continuing to pepper the market at all times. And, you know, the price action was reflective of that anyhow. So as we're trying to evaluate what types of participants are in the market, I think that the stubborn shorts are, you know, maybe stubborn in their ideas that the market needs to actually reverse back to the downside, but they're not actually committing much volume here. There's, you know, at the influence level of who influences the markets, it's clearly not stronger shorts on that Monday session, right? So I think that it's pretty clear where my head's at. I think we've had to adjust tone. And again, we're learning from early 2024 where we don't want to make the same mistake. I think changing your mind back to being bullish in the context of a broad market that typically tends to trend in the upward direction. That was the whole point of going through the monthly and weekly exercises on Saturday, is going to be fruitful. I think that's a good idea. So what other types of supporting evidence can we get into? Well, of course, let's look at some other markets. We'll keep it brief tonight. I do have some obligations to get to, so it's not going to be a full analysis per usual. But if we look at the NQ or just the QQQ cash, this opportunity, we talked about this in the pre-market prep. Look at this. This is technically an island reversal off of the lows. You have a gap down on the Friday session from 2 weeks ago. Tuesday's gap up is unfilled technically, leaving all of this as trapped shorts, right? The ideal location for a lower high would have been underneath the bottom end of this range. I was pounding the table saying, hey, I think there's an opportunity for this lower high here. PPI proved me wrong. Again, I will wave the white flag when it becomes appropriate. I will never force my will on the market. The market is always right, and you're there to trade it, right? So now that we're back inside of the balance range, I think the outcomes become very straightforward. You need to look for higher lows over that gap to keep it unfilled, basically, which would leave this as an island reversal off of the lows, and that higher low builds out the exact same indication of the inverted head and shoulders like we were just talking about on the S&P daily time frame chart. Right? You're not quite at your daily 50 SMA, so if there is just consolidation in here and then a break over this, your next major watch is this level overhead at 475. What would that do? That would neutralize the daily trend with an equal high to what was set back here. You have highs, lower highs, lower highs, lower highs. This is still an opportunity for a lower high at 467, just like we talked about in the S&Ps, with the option to neutralize if we go sideways and break. But this would neutralize immediately the trend to being flat, no trend. We have a low and we have an equal high. Now we're just looking for a higher low at 475, daily 50 SMA test. I think that's a very reasonable thing to be thinking about. So, you know, we've talked about where the bulls sort of build a stand here and make the return to glory, I suppose. But where do the sellers actually say, nope, we told you so, it's just nothing but down from here? I would keep an open mind in the NASDAQ and say as soon as and if there's a lower high underneath this level here, if that gap does not remain unfilled and we can't continue in the upward direction, lower high shorts below 453.75, are on the table if you want the best risk reward up here, ultimately targeting the equal lows at 433.55. When I say equal lows, I'm referring to the Tuesday and Wednesday session of last week that were dead on the money, same exact print, right? That's the ultimate target. Or the slightly higher confidence is getting the breakdown through the neckline of just like the S&P, the double bottom, which is in here at 448.15 down to 446.50. A little bit of a zone is appropriate considering the amount of volatility, and your risk reward on that would look something like this in the downward direction. So hopefully you'd be able to scout a tight enough stop to make that worth it, but that's ultimately the range that you're trying to traverse. If you look at your QQQ alternate set here, this is a break of the resistance trend line. However, it's not technically a higher high. I would not say that the downtrend is over just because we have a breach of the trend line. I would tend to think that the downtrend can only be called over when we have some semblance of a higher low, or at least when we produce an equal high, which is a little bit higher like we were just talking about. But it is worth noting, the S&P has not broken its trend line, the NASDAQ has. This would probably be a feather in the cap for the buyers saying, no. The NASDAQ's stronger than the S&P, and we know that the S&P is primarily composed of the tech sector. Therefore, this has to be bullish for the S&P 500. Well, not so fast. We could take a look, and we'll just sort of skip around a little bit now because the IWM is what? It's a huge failure. Massive, massive failure. Could not break out of the range successfully on the PPI. On CPI's gap up, it actually rejected in the pre-market the bottom end of this gap and the top end of this long-standing balance range and closed back within this, sort of compressed ascending triangle, if you will, below 207.80. So you've got the QQQ NASDAQ working in the bulls' favor. You've got the IWM small caps working in the sellers' favor. Talk about a push and pull market here with a lack of clarity. And again, this is why I talked about in the intro, this is one of the most dangerous junctures at any given turn in the market when the trend is changing and you're divergent in the big indexes. As we go on over to, I think the next most appropriate thing to do is honestly, again, for the sake of time, take a look at the sector posture here. I mean, here's the deal. Is there anything on this screen that shows a material shift back to risk on? I think the answer is no. And this sides more so with the bears, so that push and pull continues. And I've got bullish data points that we'll get to in just a second, don't you worry. But this is just a counter trend move in the context of a clear opportunity to reject the daily 50 SMA, the gold moving average, set a lower high and continue. Right? So not seeing like, okay, we're in the clear and it's risk on again. Financials continue to sort of hold the market together, I would argue, with this like possibly flag look building over here. This is risk off, with healthcare still pulling back for a higher low. Discretionary is absolutely in the gutter. This offers a possible higher low over the 50 SMA. Same thing with utilities. So these are obviously your risk off sectors. We're not in the clear out of that. And, even to take it a step further, I know we're jumping around like a madman today, but it's just the nature of a impromptu video like this. But I mean, semiconductors did technically, recapture the resistance area that I thought was going to be of really large concern, right? Even the 237 we described in the weekend update, if you take it down to the hourly, right? The reasoning for this was that your overhead supply is technically above. We're testing that right now. So is it possible that you could reject this and build out this neutral trend in here? I think absolutely. What's the next big catalyst for semiconductors? Look no further than NVIDIA earnings. You've got a little bit to wait on that. So is it going to be a lackluster and choppy market where everybody's going to get sort of chopped out of things ahead of NVIDIA earnings? We'll get the resolution of NVIDIA earnings and then the market makes a move that's cleaner. It's possible. It's one thing to at least think about. If you look at the XLK, so the SMH is still technically below its final line in the sand. The XLK is actually above its line in the sand, this area right here, right? And the reasoning for that is 212, as we take a look at the hourly, actually would suggest that we're trying to get acceptance inside of this range. Remember the rejection here, the rejection here. Now we're starting to get acceptance inside of that range. You could make the argument, oh, let's bring it here. That's possible. It's possible, but these counter trend moves that rejected to me, that are now holding, ironically, on this morning's open, are a bit more important to read into. So your two heaviest weight components or most influential components are push and pull with each other, as a matter of fact. Discretionary failed its big gap close overhead. This is a risk-on style sector. That doesn't look great, right? Financials, I guess we'll just do a speed round through all of them. Financials broke out. We just talked about how they're sort of the glue holding the market together right now. Industrials, towards the top end of the range, maybe a sort of pass card on that. Healthcare breaking out potentially into blue sky territories. This is a D for defensive sector. It's one of the heaviest weight risk off sectors. So we'll keep tabs on that, but that's not going to hurt the market per se. Real estate is more so neutral, no new swing high. Utilities are holding up just fine. Staples, again, looking ready for a breakout. It looks more of the posture of the market still looks more risk off to me than risk on. We have not seen a full change in trend out of namely the semiconductors and the tech sector that would suggest it's time to get back into, all of the big mega cap tech names. And oh my goodness, we're, preparing for the second bull run. It's not even the second half of 2024 anymore, but like maybe the final quarter, if you will, right? So that is interesting in the upward direction if we can get these changes in trend, but we're just not there yet in a number of the indications, right? You can see, and I think that this dashboard does a good job. I think this dashboard also does a good job that, especially this dashboard, this is your risk on, risk off indications. We want them pointing in the direction of the risk we're trying to take. If we want to be bulls, we want these things to be in uptrends. If we want to be bears, we want them in downtrends. Notice lower high, lower high, lower high, lower high. So not fully out of the woods. Everybody, sort of forgot about the Japanese yen carry trade in the blink of an eye. And this is still underneath its bearish consolidation. It's inside of its bearish territory. I think it's reasonable that you could continue to expect pressure from the Japanese yen, even if it's not as, prominent, obviously, as the max fear from the Monday of 2 weeks ago. It just, the chart structure is clearly not recapturing an uptrend. So that would stack up as a bearish data point. Now, I know we're maybe leaning a little bit more bearish than bullish, but let's take a look at the TNX, and we'll also take a look at the sort of cycle of news that we're in right now. If you look at the TNX, lower high has been produced well underneath the breakdown point. We know that the Fed is likely to cut rates, But the information we've got over the past 2 days, namely PPI and CPI, if we just jump on over here and let's grab the calendar, we do not need these alerts. Thank you very much. If we look at the release, I mean, we actually got some decent numbers here out of inflation. So the question becomes now, is the Fed possibly slated to cut rates as inflation is like approaching their target and it's responsibly done? Or is this like a panic button mode from the Fed? And with this inflation data that continues to drift in the right direction, specifically if you took a look at the PPI yesterday, the only concern I have as we take a deeper dive is actually shelter saw a small uptick here. Not even small, it's actually double, which is not small at all. But a 0.4 is not really what we're looking for out of shelter. That's one of the main components of inflation that's being read. If this is going to uptick, you can see annualized, it's a 5.1. That's going to be an issue. And I think that this shelter component is the big watch for obviously your next PCE. And we'll see how those numbers continue to progress. But aside from that, you didn't have a killer read where like everything was up. I mean, you saw huge utility piped gas come down to offset maybe what you have here in fuel oil. So we know energy is volatile anyways. If you're thinking about core, the Fed, doesn't obviously include volatile food and energy, so they're not looking at that anyhow. I think that inflation is making a decent move in the proper direction, and interest rates coming down is not necessarily going to be a response to, oh my goodness, things are breaking, recession. And remember, this is like a constant conversation that we're having in the market. You can see that the market's like, okay, maybe a single rate cut is most appropriate. And I actually believe it's either that, I hate to be this guy, but I would say like this is probably appropriate, or maybe even shifting some odds, not all the odds, but some odds for a pause to continue would also be somewhat reasonable. We heard from some Fed speakers saying more data would be fine. We're still on course to sort of cut rates into the end of the year, but more data would certainly be helpful. Again, I'm not calling for a pause in the next meeting. I think that one cut is appropriate. 2 cuts would not be the end of the world, but I think that you start to see, and again, the concern here is that if you give a double cut, all of a sudden financing costs for shelter sends this kind of out of control again, and the Fed's back on its heels about inflation. So double cut's dangerous, especially noting that if you take a look, I think this might have already refreshed. No, it didn't. Look at that. Beautiful. Beautiful, beautiful. Mortgage refinancing demand surges 35% in a week. Right? So that's the danger of the double cut right now. I don't think it's needed necessarily to react to an, oh my goodness, crap's hitting the fan and it's time to bail the market out. I don't think we need that given the data releases we've seen so far. Here's the earnings calendar. The most interesting thing that I think we can learn tomorrow is Walmart. What do they say about the state of the consumer? Especially when paired with, if we look at the calendar going forward here, this was our CPI today. We have the core retail sales also coming out at 8:30. What's the state of the consumer? Are they still spending? Remember, consumers are 2/3 of our economy. And if the consumer's getting beat up, probably doesn't look good. And again, we'll have to continue to adjust and shift this narrative based on the data and try to trade the market appropriately. At this point, the biggest takeaway, if you're like, Matt, shut up with the fundamentals, man, get over the charts, do what you do best. I think the takeaway from the fundamentals, as someone who is more of a technical trader, is just to understand that good news right now is going to be good news for the market. Bad news is going to be bad news for the market, and you should trade accordingly. That's the largest takeaway as we dive through this data and sort of try to come to terms with what it all means for the market in a nutshell. So that is what we have there. A couple of other indications I think are important to point out. Credit spreads have come down aggressively, but they're still over the top end of the bulk of this range. So this would side as a bearish data point. Is it possible to get a higher low here and move back in the upward direction? And if so, this is likely going to kick off another move in the VIX. Credit spreads expanding generally mean an increase in the volatility index, obviously. As we look at the HYG, this in isolation, this would be counter. Look at the strong move that even continued on today's session into this prior high. On a relative basis, this is a bullish divergence pointing to a move in the upward direction. So once again, if we're trying to take an unbiased approach to the market, we've talked about some bearish data points in the sectors and the posture, they're not really looking great. We've talked about the push and pull in the NASDAQ versus the small caps. And now we've talked about bearish activity perhaps in the credit spreads offering a higher low. But if you look at junk bonds in isolation, they're actually bullish. So when I say the term dangerous, it's because you have all of these conflicting indications, and at the end of the day, price is what pays. right? Price is what pays you in the S&P. If you can find those higher lows, if you can remain open-minded to a wide variety of outcomes and not be overly attached to any particular outcome, I think you're setting yourself up for a better time in the market. If we look at, where are we now? We want breadth. Let's go on over to breadth here. Total breadth chart is actually seeing an uptick out of new highs versus lows. This is a, small improvement over the span of the week, which makes sense as the market's rebounding in the upward direction. You're also seeing improvements out of the SPX A50R and 200R, which suggest, okay, a little bit more of a bullish data point here, looking for that higher low potentially. I do want to jump on over to the RSP, which is a bullish data point, breaking out through this area here. So again, really taking a balanced approach, trying to look at the data points one by one. This area of resistance, which then acted as support, it was technically a neckline for something that could have looked like this. Where did we find ourselves closing? Above the 167 handle. So as long as we can hold that going forward, this would be more of an optimistic and bullish data point for your S&P 500 down below. Let's go ahead and jump on into volatility now. Just to illustrate that the VIX is back underneath 2050, that is not acting previous resistance as a possible area of support above. We talked about credit spreads and watching out for those. That would be your sort of forecast of trying to get ahead of a VIX spike, right? If credit spreads start to find support over the top of their range. As we continue to look through some of the additional indications, though, this is where, again, I think the balanced approach tells us, I don't know if we're out of the woods yet. VIX might be a little bit broken here. Previous resistance can still act as support if you're over the 103 handle out of the VVIX. Pretty tough situation to be trading in. If we take a look at the volatility futures, we are still, we're right at, I guess technically contango, that's a positive here, but we're right at the zero line. Contango, backwardation, where are we? We're right there. There's an opportunity for these things to flip right back lower. And again, that really spells more pain for the market. So this juncture, I might sound like a broken record now, but it's just as much for me as it is for you. I'm trying to reinforce this to my own brain. Just, wide range of outcomes are possible here. Do not get hung up on any particular outcome and keep that open mind. Chris Shavako comes to mind, his little final commentary as always, right? Anyways, this here on the one-day VIX over the 1275, if this is going to stay elevated, that would speak to more pain in the market, right? It's not all the kinks have not been worked out of the system. So that's volatility. That's a quick look through your broad market indications. We could do a speed round through some core list of companies because these will be influential over the broad market itself in my belief. So let's do that now. If we're taking a look at Softy on the daily time frame chart, we need to respect the opportunity for a lower high at 416. The trend here is down, and this is still ideal location. Look at previous support, now possibly acting as resistance. On the hourly time frame chart, what do we see? Not a whole lot of rejection there on today's session. A couple of upper wicks, sure, but much more so price acceptance towards the high of day over the 50% mark of the range, of course. I would have to see a bit stronger of an indication for downside. If we do something that looks like this, there's maybe your head and shoulders with a flat top. So the lower high under 416, depending on where we open tomorrow, might be interesting for some downside. And the pullback wants to be into 408.75. Something that looks like this, reevaluating when we get here. The whole premise of today's video is to basically acknowledge that if this sets a higher low, we'll have to change our tone more meaningfully. We will look for an equal high breakout. But first thought, because the daily trend is still very much so intact with the opportunity for that lower high, this is a top of mind short watch early on for a pullback into, even if it's just a retest of this, even if the trade only lasts from point A to point B, great. The structure really suggests that that's more likely compared to upside continuation. If we are up here and if we're not getting any lower highs under the 416 handle, I would not just blindly be shorting it up here. That's not how that works, right? You need to see that setup around that 416 key level. Next up, Apple. What's going on here on the daily time frame chart? This has been our relative strength monster. It has recaptured this level. It's spending more time over this area as well. Previous resistance now acting as support and support. It's cleared its daily 50 SMA. Huge improvements here out of Apple. So the big watch is just to determine where either a consolidation range takes place, and then we have a breakout through the 224 for some upper levels, or if we pull back under 219, I would be looking for a catch and support, daily higher low off of 212.75. Let's get you a couple more levels actually to the upside here. I would be concerned about 233 as a possible upside continuation play if this market's going to continue out of Apple. So consolidation, break, sort of Brigade bolt there, and that would be a higher low over this level from the past. Pivot high, then turning to support, right? 224. So that's Apple. No need for the hourly chart. This thing's fine. It's just a grind in the upward direction. NVIDIA is a tough one. NVIDIA is really a tough one. Remember, we were talking about earnings not too long ago when we were talking about the SMH chart. But what do we see here? I mean, the competition of the timeframes is as clear as day on NVIDIA because you've got the possibility, pretend this is a weekly chart. There's your weekly double top. You could call it a daily double top, whatever. You've got this neckline. It's been tested once after a lower low was produced, even a lower low in here. And you've got that lower high that was set. You've already got an equal high now to this area right here. You've got equal highs. So is it possible that NVIDIA becomes difficult to trade because the trend has neutralized? I would tend to think the answer is yes. The bears are really looking for another rejection of this area, but I would tend to think that just like the broad market, this as a higher low opportunity, primarily over 107.50, is really what the bulls want to see. Then we call this thing obviously inverted head and shoulders. Over the neckline, it's off to the races. The only issue is that earnings can throw a wrench in the mix of this. So for the remainder of this week's session, I would really, you've got to take a day-to-day approach here. If you can clear these highs, you are building a bit of an ascending triangle over 118 with a Brigade bolt. As long as you can manage risk, upside might be doable for some sort of risk reward that looks like this, at least a 2-to-1, be aiming for that into 122. If we reject up here, and let's say that tomorrow morning we open here, this maybe starts to imply a double top, and your neckline is the 115.75 support. Lower highs below that probably start to look for, that was a little bit of an overshoot, but the pullback for the daily higher low we were just describing, 107.50. Next up, we've got Google. An absolutely trash chart. It's been that way for a little while now. It's all inside bars after the Monday gap down from the Japanese yen panic debacle. Nothing to do here until we get out of 165 or out of 156.50. Next up, skipped one, sorry, Amazon. A little bit lackluster, and we talked about this on the XLY, the consumer discretionary chart. Break into the gap. The gap faded aggressively to the downside today. It's paramount that you hold here. You've got to hold and continue to rotate through the gap if you're trying to remain bullish in Amazon. Otherwise, this easily sends you back down here. The trend is still down on the daily because this is a massive lower high. And that, again, is, just opens up further downside. Ultimately, the target becomes the equal low at 154.50. So Amazon, we can actually take this down to an hourly, would be pretty straightforward in my view as to how we're going to interact with it into the end of this week. If we're holding above, great, trying to fish for longs up into that 172.85. If we're underneath here, I would, if you can pull it off, great. Quick draw McGraw is a short from point A to B, but the best short is just underneath this flat low into point C down here. That would be 166.25 into 161.25 after setting a massive daily lower high, right? And that would be that after the failure to move through the gap. Remember, there's thin structure overhead. Why? There's no reason for the bulls to fail unless nobody literally wants to buy, right? So that is Amazon. Next up, let's take a look at the metaverse. What's going on over here? Round trip. We talked about this morning in the pre-market prep. So reasonable little inverted hammer printed on today's session. I would argue this is a top watch for a short as we head into the remainder of this week. Oops, all over the place with the charts here. Sorry, as we're trying to grab the right tool. Reason this is a top watch for a short is because we look above and fail. Right, we looked above the previous day's high. We failed to find acceptance, even over the top of that key level. Any sort of subsequent, this is already starting to unfold right now. The Brigade bolt is basically this right here. The lower high rejection, if it can hold into tomorrow's session, has already started into the end of today. So 528.50, if we're getting lower highs below that, you could even start to, consider how that maybe is head and shoulders, retracements into here, and really the stronger retest on the daily is at 506.50. So on the daily, that would look something like this. We reject, we, sort of pull back in here, and then looking for a reversal off of this to act as a daily higher low. Line in the sand is at 493. I would still use 506.50 as the primary watch just because we've interacted a couple times with it already, but the line in the sand, the absolute no ifs, ands, or buts about it, 493 coming from the previous bottom end of this balance back here. Next up, Tesla, failed breakout today. This also has something to do with discretionary, the XLY chart we were seeing. So it's kind of at do or die moment. I don't really like, as we get granular on the hourly, you can see the afternoon consolidation is technically under 201, so not thrilled with this. Honestly, was looking for more of a move to hold that. So keeping an open mind early tomorrow, if we can get over 201, great. I'll look for opportunities to enter here just because the risk reward is stellar. If you could do something that looks like this again, that's another strong opportunity. But if we're just kind of struggling in here, I would sort of take it off watch. As we've talked about for a number of episodes now in a row, I don't think that it's a wise idea to be a new money short into this previous choppy range. There was just too much stagnation back and forth, too many possible positions being built in there. I think it's going to be a very difficult trader through that range. Next up, JP Morgan, daily chart. retest, double top neckline, right? So if this is going to offer the classic Man Ray pattern and bring in a right shoulder here, 209.50. Unfortunately for those bears, look at the break into the afternoon session and possible hold above. So I think if you missed the move, and we had talked about this as soon as, what was it, into the end of last week, Friday, Thursday, right? We were talking about the cup and handle here. If you've missed the move from point A to point B, I don't know I would be I'm just saying I would not be a new money long up here until two things happen. Either consolidation takes place around this and we get an arbitrary high or low, in which case the recapture of the equal high gets you through the thin structure here into 213.25. It's a little bit harder because obviously you're speculating on, when is this going to happen? Is it going to happen? Or if there is a deeper pullback, something that supports off of this 204.25 gives you decent risk reward opportunities back into at least the equal high test. If you're trying to set up a sell side action here, sell side trade up against this neckline, you would have to see, very similarly to Meta, some sort of look above and fail on this level. A lower high under 209.50 brings you back down into this 204.25. You would be trading from point A to point B down here. Next up, Netflix. It's got a mind of its own, so do with this what you will. We had sort of talked about this mind of its own a little bit in the pre-market prep today. It did make it to target. Kudos to anybody trading Netflix, but it's the wild wildebeest at this point. It's not really respecting the technicals as we walk forward. So we'll see if it wants to reject off of this overhead supply low. If it does, great, some sort of pullback, maybe an equal high breakout, then gets interesting to try to make it back up towards that all-time high. But for now, I would tend to think that you've missed a bulk of the move, and it was very difficult to participate in. So kudos if you got it. If not, don't sweat it. I mean, that was very, very tough chart to be interpreting. If we take a look at AMD, AMD is, I would argue, not looking good. And the reasoning for that is over 135, I wanted to see more acceleration. It was a slow grind higher, and as soon as we came into a known area of resistance, the market's already backing off. Now, yes, we did get a lower wick on today's session, but as you take a look at this, it was pretty severe, that morning drop-off. It was not just like, oh, gap fill reversal and starting to pressure those highs again. It was gap close and some into the prior day's range and never getting back out of the previous day's range. So what I'm seeing is like maybe a slow grind in the upward direction, but the longs here are not really ideal. I would start thinking about where are the opportunities because the daily trend is so clearly down. Highs, lower highs, technically a lower high here. Can this offer a lower high? Do we just get consolidation? In which case the slip of 135 should be a decent short into the lows at 122.25, right? So I'm thinking about AMD bearish outcomes. It would help if the semiconductor space just weakened in general ahead of NVIDIA earnings, not praying for the downfall or anything, but just as a trade mechanic, a tailwind here for the sellers would be helpful. We're not there yet, but I'm just not quite sold on the long side yet after today's pretty harsh reaction off of that key level. That's what I've got for you in today's episode of the Midweek Market Update. A little bit bastardized with some cuts and jumps and not as formal of a process as usual, but we had to get it done in a specified period of time, so I hope you enjoyed. If you learned something new, at minimum, if you're able to keep a more open mind into the end of this week, that is going to be counted as a win. That's what my main goal is into the end of this week. But let me know how you feel about the market. Do you think that these are overconfident longs? Do you think that these shorts still have the right of way, that the market should be headed lower? Let me know your thoughts on this battle of the timeframes in the comment section down below. If you're not interested in commenting, a thumbs up goes a long way to support the channel. And with that said, I wish you all a green trading week. And as always, I will see you in the next one.